How many of you would like to have a complete stranger come pick you up and know where your house is at? Well, a lot of people do apparently. Shoot, we're going to be talking about Lyft stock and what the crap is going on with this wild stock right here. So Lyft is up there with Uber as one of the major ride-sharing services. Ride-sharing services just being somewhat of the modern-day taxi, I would say. Whereas, normally you'd hail a taxi before. Now you have an app and you call for anyone in the local vicinity to come and pick you up. So whoever accepts your request will come pick you up. And then it's the same process. You pay them the nominal fee there and a tip if you so please. Typically you will pay a tip, otherwise they'll be upset at you. But and then they ask you to review the person. So I do think that is an interesting concept too. It's a little bit. It's I would consider it a better taxi service, and I don't think there's any denying that at all. Taxi services certainly will not be existing in the next 5 years. I just don't necessarily see it being a service that necessarily makes sense when you have all these companies coming out and offering these ride-sharing services. It just doesn't really make much sense. But we're talking about the stock here. So obviously, one thing to note, you'll see here a pretty big downward movement this week. They reported earnings down 3% this week, but overall, since their IPO back in May, let's see, I was actually in March, ended on the last of the month on March, so down 45%. This baby opened up around $78. And now it's around $42. So you might be thinking, well, that's some screaming value right there, right? That sounds fantastic. No, I hate to say it. I don't think it's not at a safe valuation yet, and I got some reasons for it. We'll first go into the earnings there. I just want to take a peek at their earnings, and we'll see what happened. So they did have a very fantastic earnings, actually, but the stock went down as a result. Non-GAAP EPS, again, and you'll see here, it's not a profitable company by any means, but they did beat their numbers significantly, and they've improved on profitability quite a bit. They're still not profitable, but they have improved quite a bit. And revenue jump of 63.4% year over year, pretty darn nice. If you ask me, that's a very good growth in revenue. I mean, that's what you love to see. That's what they're expecting to see. Lyft trades higher. It's reporting Q3 revenue of $955 million. The guidance range was $910 to $915. Consensus mark was $915, so they beat that handily. Adjusted loss arrived at $128 million. Guidance was $210 million negative to $263 million. So again, a lot better. Nearly half of what they expected in terms of loss, which is very nice. Riders were up 28%. Revenue per rider was up 27%. Love it, love it, love it. So that's pretty good. They barely beat on that rider aspect. Nothing too significant. Lyft sees revenue of $3.57 billion for the full year, versus the consensus or prior guidance 3.47 to 3.5. So again, that's good. That's quality. An adjusted loss of $708 million to $718 million. Not so good. My opinion on money losers. I don't like companies that are losing money, and in a full year, if you're losing nearly $1 billion, I don't like that. And I've criticized Uber stock about it. It's the same situation going on there. Not money winners, but let's go into some of the specifics. Okay, see what they have to say. Margin improvement year over year, gotta love it. Revenue growth year over year, 63%, and $3 billion in cash. Okay, so they do have cash. Obviously, I love to see a company that has cash. We gotta love that. We'll have to look at the debt numbers in a little bit, but there's a revenue growth, after active rider growth. I love these charts. Revenue per rider increased. Margin improvement. Operating expenses. You can see here the improvement here. So again, you see operations and support about the same percentage here. A big decrease in terms of sales and marketing. I think a lot of that is going to be just off the marketing aspect of it. They were trying to get that name out there originally, so I think that's where they've cut down a lot of that expense. But other than that, every expense has pretty well stayed the same. Obviously, it's fantastic improvement in terms of adjusted net loss. That's fantastic. The thing is, it's going to be needing to see a trend there. I gotta love it. Improving operating leverage, look at that. And margin, obviously, gotta love that. Quarterly revenue, they'll show you a lovely chart, which you love to see a good chart like this. That's a good looking revenue chart. They are growing business quite a bit. And again, here's the outlook in terms of revenue. So next quarter, they see 975 mil to 985 milo, which represents a 46% growth year over year. So in their adjusted loss would be 170 to 160 milo. You know what? That's not awful. And then here's those full year 19 outlooks that they were giving there. So again, represents 66% increase over last year's. If that comes true in terms of their outlooks, and that is an improvement from their outlook quite significantly, because they were expecting a lot higher of a loss as well as lower in terms of sales. So that is certainly a good thing to consider. I love this. Look at this net loss line. I know it's a little tiny, but net loss line, if you're looking at that, I mean, it's not a trend you like to see, but it's improved since the start of the year. Obviously, two quarters ago, you see there's that 1.1 billion number. That's rough. Right now, around 400 billion. That's rough. Q3 net loss of 4. So that means again, we talked about this. They have $3 billion in cash. The way they're set up right now, it looks like they're going to lose. In a full year, let's be fair. It looks like they're going to lose, on a normal year, let's say, $2 billion. I think it's a little bit unfair. Q1 was a lot more in terms of loss from operations than expected. Obviously, you can tell that. But shoot, they're going to run out of cash in a year and a half if you look at that. Obviously, there's a good downtrend from Q1, but if you look at the early days, obviously revenue wasn't nearly there, but again, their net loss was a lot less. Looking at 120 million versus this most recent quarter, 400 million lost. It's something to consider. And if we're looking at, me, I love looking at liabilities. Liabilities are my baby. Current liabilities around 270 or 2.7 billion. Total assets around 5.7 billion. But that being, as far as the cash is concerned, is that 3 billion number. I don't like it. I don't like that high amount of liability. But again, it's kind of what you expect from a company that is, they're not profitable, and the question is, when will they get profitable? That's obviously the concern. That's all I really wanted to point out in terms of this earnings here. One more noteworthy point too is that this is a very, very fast growing market too. Expected to hit 169 billion in terms of total revenue spent on ride sharing in terms of by 2025. So that's nice. Obviously, that's very nice. That's not denying it. That's very significant growth, 18% year over year, every year. So the question is that good? Does that mean Lyft is worth it? First, I would say, obviously, you see this number for a lot of reasons. I think we're in a big transition in terms of just where we're at. Just going to the overall of the stock here. So I think we're in a big transition in terms of motorized transportation, and I don't think there's any denying that. Obviously, we're switching from gas. We went to hybrid a few years ago, 10 years ago maybe, and I mean, hybrid never really stuck. Now we're transitioning to electric vehicles, and I think part of that to alleviate is going to be the use of these ride-sharing services. So for a lot of people, it can tend to be cheaper than car ownership, depending on how much you're going to be driving. They can usually get off cheaper through the use of ride-sharing services, and I know a lot of people do it. And obviously there is the perspective of, well, it's more beneficial for the environment, right? Whatever they might want to say in terms of that. Because I guess it is less cars on the road, so I mean, you're just using your Lyft driver's car. I mean, it's still a car on the road, but we'll get to that point when we get to it. Again, I think Tesla's going to be starting a ride-sharing service as well, which again, it gets more electric vehicles, because right now with these Lyft and Uber, it's their own independent people are using their own vehicles for these services. It's not like company-issued vehicles. So regardless, I don't know if you're necessarily more environmentally conscientious using one of these, but I think there are certainly some viable options why these might be useful. I personally am not a huge fan of the idea. I'm not a very trustworthy guy, I would like to say. I'm not going to get in a stranger's car. That's just kind of how it is. Not only is it awkward, but I just don't know, in this day and age, if I trust people that much to where I would get in someone's car that I don't know, nor do I want them knowing where I live, nor work, whatever it might be. That's my perspective on the matter. But I know a lot of people are open with that, and they don't care. But I think part of that opens up a lot of liability risk in terms of both Uber and Lyft. I mean, if you think about it, these are people they're hiring. They're contracted under them. Not necessarily contracted, but these are their employees. If something were to happen, if they let someone slip through, background checks, whatever it might be, and something were to happen, I mean, that is a mega lawsuit, and it's a mega hit to their business. Just from my perspective, if you think just random, I mean, it might not happen. It might. One of their drivers decides they want to rob one of their people, that's ordering a Lyft sharing service. They could. Obviously, that would be handled properly, but just think about how that tarnishes the brand and how that is going to affect them in terms of legal costs. Because let's just be honest, if you're a smart person and something happens like that to you, you're going to sue for all they're worth. I mean, you're going to sue for emotional trauma, you're going to sue for this, and then other people are going to get involved in that. That's just kind of how it goes. That's why I hate lawsuits. They're frustrating. So I'm considering the perspective of legal concerns. Now, as far as the process, I think Lyft they run a good business. But ride sharing just isn't profitable, and I don't foresee profitability for several years down the road. It's a big thing that they'll have to figure out. Obviously, one of the issues too is increasing wage costs. It definitely hurts them a lot. So if they're paying higher wages, a lot of that's just, instead of paying mileage, stuff like that, they're going to be paying higher wages to keep people on board. They don't necessarily make the money on that because they're paying their drivers so much, I think that's part of the issue where you see that net loss. A lot of it is that loss from operations is going to be that money there that they spend to their employees that they are not making. So I would personally consider the fact that this is a company that will not be profitable for a long time. I don't think it's going to die. I don't think it's going to be a company that dies. Obviously, they're growing revenue quite rapidly, and I think that's very interesting. I just don't know if I necessarily see the value in terms of the stock right now. I think there could be some value at some point. I'm just not a guy who likes to invest in in companies that don't make money, and you know that. The only time I would is if I think that they will be making money in within a year, maybe. This is not a company that will. So if you think about it, this is a company that could get killed. It could, depending on what happens. Uh, Obviously, it'd have to be a whole hurricane of occurrences, in my opinion. But there's going to be more competitors stepping into the network. There's going to be more difficulty when you hire more people. There's just a whole lot more liability that comes into play here. If one of your Lyft drivers causes a car crash with someone in there, it's just liability ridden. I think that's one of the concerns with these ride sharing services personally, and I think it's I also think this ride sharing services they're detrimental to the auto market and detrimental to the economy as a whole as well. Just not necessarily bashing in that way. I don't want to say that's a hit on the stock. I mean, it's good for them if they can grow business, but I think it certainly hurts the economy as a whole. People buying less cars, they're relying on these ride sharing services. That's my opinion on Lyft stock. I'm not going to tell you to buy it. I wouldn't personally say it. I don't think it's necessarily done hitting that. I mean, it's still rolling. It's tumbling down a hill. I don't think it's hit a cliff. I just think it's rolling down a hill slowly, and I don't think it's bottomed out. Such a good earnings, and they still couldn't muster positivity from it. I mean, in my opinion, it's slightly scary to see where this stock goes. I think it could trade flat for a while. I just don't necessarily see any upward movement for a while. I think entirely all the price based on this price is entirely based off of hype and the potential in the future, which I do understand. You see the same thing with Tesla. Again, not a consistently profitable company, not worth what it's valued at right now, but people price in the expected growth. And I don't think that's necessarily unfair, but it's an unproven thing, and I am not that much of a risk taker. But then again, we'll see how things go. Keep an eye on Lyft stock. I think it's an interesting one to look at least. Out of the two between Lyft and Uber, I lean more towards Uber, I believe. But I'm not a huge fan of either company. Sorry to say it, guys. Not a huge fan of either, but if you're invested in it and you believe in the strategy, I don't blame you.